Welcome to our deep dive today into this really intriguing world of personal finance. You know, we're going to be really taking a look at Morgan Housel's The Psychology of Money.
Okay.
And in that, we're hoping to uncover a lot of those psychological factors that shape our financial decisions. It's not always just about the numbers,
Right.
It's about the stories and the biases that we bring to the table when we're making these decisions about money.
Yeah, and it's funny because a lot of times, we'll treat finance as if it's just this rational game,
Right.
with numbers, and it's all very straightforward.
Yeah.
But Housel really convincingly argues that it's the soft skills, the ability to manage your emotions and your expectations that actually play a much bigger role than maybe we realize.
Yeah, I think that's a great point. And he illustrates this really well with a story about this tech genius
Yeah.
who designed this really key component in Wi-Fi routers. So, really brilliant guy, makes a lot of money, but he was flaunting his wealth like a teenager.
Yeah.
And it makes you wonder.
Yeah, I think it just shows you that success in one area doesn't necessarily translate to another.
Right.
Just because you're really good at something technical and you found success there
Yeah.
doesn't mean that you're going to be financially mature. Maybe it's just that finance, is a lot more than just numbers.
Yeah, and it's a lot more than just, knowing what to do. It's about grappling with the emotional side, the psychological side
Right.
of yourself.
Right.
That makes you kind of think about those flashy success stories that you see sometimes. And it's do those stories always tell the whole story?
Right.
And Housel really dives into how our own experiences really shape the way we think about money.
Yeah.
Someone who's been through something like sky-high inflation may view bonds totally differently than someone who hasn't.
Absolutely. And he gives an example from the 1960 election where John F. Kennedy, his lack of firsthand experience with the Great Depression actually became a talking point. People question whether someone who hadn't actually lived through that kind of defining economic event could truly grasp the impact that it had or relate to the struggles that people had.
That's really interesting. So it's those formative experiences, those family dynamics, they become hidden scripts almost.
Yeah.
They influence the way we make our financial decisions.
Exactly. And I think all these diverse backgrounds then create all these different perspectives, right?
Yeah.
On risk, reward, all those things. Just think about how different generations might view something like the stock market.
Yeah.
If you've witnessed decades of these really good returns, you might be a lot more bullish on it, right?
Yeah.
Compared to a generation who's seen markets stagnate or even crash.
Yeah, that makes sense. But what about choices that just seem totally irrational? What about people who spend a huge chunk of their income on lottery tickets, for example?
Okay.
And they're barely scraping by. Those stories are the ones that make you kind of go what's going on here?
Mm-hmm. I think, even with something like that seems illogical. If you look at the person's individual narrative and their circumstances, it might make perfect sense.
Okay, yeah.
It's not about judging the decision,
Yeah.
right? It's about trying to understand, what are the factors that make it seem rational to that person? Maybe to that person, the lottery represents hope. It represents a way out.
Right.
And maybe that hope to them is worth a lot.
So it's less about saying that, that was a bad decision and more about trying to understand the why.
Yeah, yeah. And this idea actually connects to something else that Howells talks about, which is luck and risk, right?
Yeah.
And I think those are things that we often overlook when we evaluate success or failure.
Yeah.
We tend to attribute outcomes to just individual effort.
Right.
But we forget how big of a role chance plays.
Yeah, and he uses Bill Gates as an example of that.
Right.
Growing up, one of the few kids who had access to computers in the 1960s. That's some incredible luck. That set the stage for his success.
Right. Imagine if he hadn't had that access.
Yeah.
His story could have been totally different. And in fact, he contrasts that with one of Gates' friends, Kent Evans, who was equally as brilliant, but he died young.
Oh, wow.
Right? So it just shows you luck sometimes is the deciding factor, even when you have all the talent in the world and you work really hard.
Yeah. That's a really sobering thought. So sometimes it's not just who's better, but who got those lucky breaks along the way.
Totally. Totally. And this applies to risk, too. He gives this contrast between John D. Rockefeller, who basically became insanely wealthy by skirting the law, and Enron, who did the same thing and ultimately went bankrupt, right?
Right, yeah.
So the line between boldness and recklessness, it's really thin, and sometimes luck is what determines which side of that line you end up on.
So I guess the question then becomes, how do you make sense of success and failure when there's all these unpredictable things?
A good question.
Do we just kind of like throw our hands up and say, well, it's all random?
Well, not quite. While we can't control everything and we can't perfectly predict what's going to happen, Housel says that instead of trying to replicate these extreme cases, we should look for broad patterns of success.
Yeah, that makes sense.
Right. The more common the pattern, the more likely it is that we can apply it to our own lives.
Right. It's easy to get caught up in these stories,
Yeah.
like overnight riches, these huge failures.
Right. Exactly.
But oftentimes they're too unique to really be a good guide.
Right. And I think this perspective should also encourage us to be more compassionate,
Yeah.
when we're judging ourselves and others. Like sometimes someone fails and it's not because they didn't try hard enough. It's just because they got unlucky.
Yeah.
Right. And we should be okay with that.
I love that quote from the book where he says, nothing is as good or as bad as it seems. It makes you realize there's always more to this story.
Yeah.
And speaking of stories, he tells this really captivating story about Jesse Livermore, who was this Wall Street legend. He made a fortune in the 1929 crash, but ended up losing everything later on.
Right.
What's the lesson in that?
I think Livermore's story is a cautionary tale about the dangers of overconfidence and leverage, right?
Yeah.
Especially when you combine those with these really volatile markets.
Mhm.
He basically went from winning big to being totally broke.
Yeah.
And in the end, he took his own life.
Mhm.
It's a reminder that even if you're super successful, you can still be your own worst enemy sometimes.
It's a cautionary tale. And he also talks about Rajat Gupta, who was this former head of McKinsey who ended up being convicted of insider trading. It's a different kind of story, but equally fascinating.
Yeah.
Here's a guy who achieved all this success,
Right.
yet he risked it all for some pretty quick gains. Why do you think he did that?
I think that speaks to this idea of easy money and how seductive it can be.
Right.
It can even make really smart people blind to the risks they're taking. Yeah.
And it's about instant gratification, right?
Yeah.
And like short-sighted thinking, even if you have it all.
So for those of us who aren't billionaires playing these high-stakes games, what can we do to avoid these psychological pitfalls?
Well, I think Housel really emphasizes defining enough for yourself.
Okay.
Like what does that mean to you? What are your financial goals?
Yeah.
What are your values?
Right.
And he says that like one of the most difficult financial skills is getting that goalpost to stop moving.
Okay.
Like if every time you get more money, your expectations and desires also go up, you're never going to be satisfied.
It's like that saying, happiness is just results minus expectations. If you keep raising those expectations, you're never going to catch up.
Exactly. Exactly. And I think a lot of that comes from social comparison, right?
For sure.
We're constantly looking at other people. We're measuring ourselves against them. And that really distorts our perception of like what's a good financial situation.
What does success really mean? And it just leads to this endless chase for more, even if it's not actually what you want.
Yeah. So the key is to define your own version of enough, to step off that, that treadmill and focus on what brings you real contentment and meaning.
Yeah, I think that's beautifully put.
Thank you.
And even Gupta, after everything that happened with the insider trading, he said that losing his reputation was only really troubling because he was so attached to it.
Yeah.
And I think that's a powerful reminder, right? Like integrity, our values, genuine connections, those are the things that are really valuable. They're much more valuable than any amount of money.
Yeah. And it's a reminder to keep things in perspective.
Yeah.
And speaking of perspective, Housel then shifts gears and talks about compounding. He compares it to these like slow, almost imperceptible formations of ice ages. It's this idea that, just like those cool summers gradually building up to an ice age, consistent investing lets compounding really work its magic over time.
Yeah, and it's a great analogy because it shows how these seemingly small, consistent actions, just repeated over and over, can lead to these really big results. We tend to, overestimate what we can do in the short term.
Right.
And vastly underestimate what's possible in the long term.
Yeah. And of course, he uses Warren Buffett as a prime example, right? Highlighting how the majority of his wealth wasn't some secret formula. It wasn't these risky bets. It was just consistent investing over decades.
Yeah. It's about staying in the game, right?
Yeah.
Not about being flashy or trying to get rich quick.
And that's where time really becomes that secret ingredient, right? It's the thing that really amplifies those consistent gains.
Absolutely.
And he compares Buffett to Jim Simons, who's a brilliant mathematician,
Right.
who had much higher average annual returns than Buffett. But you know what?
Yeah, but he didn't have as much time.
Exactly.
Right.
Even though he had these higher average returns, his overall wealth doesn't even come close to Buffett's. And that's simply because of the length of their investing careers.
Totally. Totally. It just shows how time, if you combine it with consistency, it's the ultimate multiplier.
It's like mind-boggling how much those extra years compound those returns.
Yeah.
And he even does this thought experiment where he calculates what Buffett's wealth would be if he started investing like just a few years later.
Yeah. And it's crazy, right?
Yeah.
It's much, much less.
So it really makes the point that those early years, even with small amounts, are just so crucial.
Yeah.
It's not just about how much you invest, it's when you start and how long you stay invested.
Totally. It's a great argument for starting early, right?
Yeah.
And staying committed, even when it seems boring or you're not seeing the results you want immediately.
It definitely makes you think about the long game. And, speaking of long-term trends, he uses this other really fascinating example. Hard drive storage capacity.
Okay.
In the early days, it grew so slowly, but then in the past few decades, it's just exploded.
Yeah.
And it reminds me of that saying, like the biggest shortcoming of the human race is our inability to understand the exponential function.
I love that quote. Yeah.
It's like we tend to think in these straight lines.
Right.
Like the things will continue at their current pace, but with compounding and with technology, that just isn't the case.
Totally. Even those who were really optimistic about hard drives in the beginning, they were still surprised by how much they grew.
Yeah. So patience, right. That's the key takeaway here. Find those good returns, stick with them for years, even decades, and let that compounding work its magic. Don't chase those short-term gains.
I think that's a really good way to put it. Yeah. Slow and steady wins the race when it comes to wealth.
It makes me think twice about all those get-rich-quick schemes that are out there. They might work for a few people, but I imagine most people end up worse off.
Yeah, and Housel argues that a lot of those schemes are focused on optimizing for the highest possible return, which can be really misleading.
Okay.
What you really want to optimize for are the returns that you can stick with for the longest, right?
Okay, yeah, that makes sense.
Because that allows you to ride out the ups and downs and let compounding do its thing.
So it's about that sweet spot between, good returns, but also sustainability.
Yeah.
It's about balancing ambition
Yeah.
and being prudent at the same time. Now let's talk about something that I think is like essential but so often overlooked.
Yeah.
Planning for the unexpected. Housel highlights this concept of room for error, which he learned from, of all places, Las Vegas card counters. What can we learn from these guys?
Well, what's interesting is that even the most skilled card counters, they've studied the odds, they know what they're doing, they still know that they can't bet everything on one hand.
Okay.
They know that even with a winning strategy, they could still be wrong,
Yeah.
right? That something unpredictable could happen and mess up their plans.
Yeah. So it's not about eliminating risk.
Hmm.
It's about managing it in a way that, keeps you in the game, even when those unexpected things come up.
Exactly. Exactly. And Housel talks about how room for error means you have to acknowledge that uncertainty and randomness are just part of life,
Yeah.
especially when it comes to money, right? You need a gap between what you think will happen and what could happen.
Right, right.
You need a buffer so that if you make a mistake or something unexpected happens, you can recover.
He's got this great quote from Kevin Lewis, who's a card counter.
Yeah.
He says, although card counting is statistically proven to work, it does not guarantee that you will win every hand, let alone every trip you make to the casino. We must make sure that we do not bet so much that we cannot afford to lose.
Yeah. And it's such a good point because even with the best strategy, you have to plan for those times when you're going to lose. And this doesn't just apply to gambling, right? It
No.
applies to investing and really life in general.
It makes me think of that concept of a margin of safety that Benjamin Graham talks about. It's not about avoiding risk completely because honestly, that's impossible most of the time.
Yeah.
It's about reducing its impact when things inevitably go wrong.
Right. Right. And Housel explains that margin of safety, whether it's cash you have saved or a diversified portfolio, it allows you to ride out the ups and downs of the market and stay in the game for the long term.
And he brings up Bill Gates again, who insisted on having a year's worth of payroll in the bank, even in the early days of Microsoft.
Right.
That's some serious financial prudence.
Yeah, even when they were growing like crazy and cash flow was tight, he knew that you got to be prepared for anything, you know?
Yeah. So it's not just about surviving financially, but also about like that emotional resilience.
Totally. Totally.
If the market drops 30%, that could be devastating, not just to your portfolio, but to your confidence.
Yeah, and Housel talks about how there needs to be this gap between what you can handle financially
Right.
and what you can handle emotionally. Because when we're stressed, when things are uncertain, that's when we make bad decisions, right?
Right.
So we need to be prepared for that emotionally.
It makes me think about retirement planning.
Yeah.
We might assume the market's going to have like a certain average return. But
Right.
what if that doesn't happen? What if there's a downturn right when you're about to retire?
That's where the margin of safety is so important. You have to plan for different outcomes, right? Things might not go perfectly.
Yeah. This also makes me think about the dangers of leverage.
Yeah.
Taking on debt to try to boost those returns might seem smart when the market's going up.
Right.
They can really backfire when things go down.
It can, yeah. Housel says leverage can turn these ordinary risks into catastrophes.
Wow.
We tend to underestimate the odds of things going wrong, especially when we're feeling good about the market.
Yeah.
But those rare, like black swan events can really ruin you, especially if you're using leverage.
So always factor in that room for error,
Yeah.
both financially and emotionally.
Yeah.
Be prepared, have a backup plan, and know that things don't always go the way you think they're going to.
Absolutely. And I think that mindset of preparedness, that margin of safety, can be applied to all sorts of areas of life.
Okay, yeah.
Not just investing, but your business decisions, your relationships, even your own self-care.
Yeah. It's like having a little bit of humility, knowing you might be wrong,
Right.
and being prepared for when that happens.
And Housel gives this really interesting example of German tanks in World War II that were disabled by field mice.
Wow.
It sounds crazy, right?
Yeah.
But even something that small and seemingly insignificant can really derail even the most sophisticated plans.
So, I mean, how do you guard against those unknown unknowns, those things that just come out of nowhere?
Yeah.
Do you just become super cautious and avoid all risk?
Well, you don't want to be paralyzed by fear, right?
Yeah.
I think Housel suggests avoiding single points of failure.
Okay.
Like if one thing goes wrong, will your whole system collapse? If you diversify your investments, have multiple income streams, even have a diverse set of skills, then you're less likely to be completely wiped out by one event.
So it's like spreading your bets across different areas of life. Like build some redundancy into your plans just in case those metaphorical financial field mice show up.
Exactly, exactly. Have options not just in your money, but in your skills, your relationships, your whole approach to life. Be adaptable, be resilient, and recognize that change is going to happen. How you handle that change, that's what determines your success.
And this leads into this idea of the end of history illusion, right?
Yeah.
We often underestimate how much will change in the future.
Right.
And this leads to unrealistic plans.
It's like we think we're the finished product, like who we are today is who we'll be forever.
Right.
But we're always changing. Our values change. Our priorities change. Even our personality can change.
Yeah.
As we have new experiences and new relationships.
He tells a story about a friend who worked his whole life to become a doctor. Like it was his dream.
Yeah.
And then he achieved that dream and he was disillusioned.
Right.
It just goes to show you your goals and aspirations can change over time.
Yeah. Yeah. And if you're stuck on this fixed plan based on who you used to be, it can lead to a lot of regret. You have to create space for change, right? Let your plans adapt as you change.
Yeah. And he also points out that only a small percentage of college grads end up working in the field they majored in.
Yeah, totally.
And it just shows that your interests and passions change.
Right.
So, locking yourself into one career path, that's probably not the best approach.
Yeah, be flexible. Right.
Right.
Build a foundation that lets you explore and pursue those new things that you might discover you're passionate about.
Yeah. So the question then becomes, how do you plan for a future self that you can't even imagine?
It's a great question. I think instead of focusing on specific outcomes, you should focus on creating options.
Okay.
Build a foundation that gives you choices.
Right.
That way you can pursue those new opportunities as they come up, even if they're not what you originally planned.
Yeah. It's almost about embracing the unknown, except that your future self is probably going to surprise you.
Yeah.
And create a financial framework that lets you respond to those surprises.
I think that's a really good way to put it.
Okay. Now let's dive into the importance of defining what enough means to us. Housel shares his own decision to prioritize financial independence and paying off his mortgage.
Yeah.
Even though it might not have been like the best financial choice if you're looking at, maximizing returns.
Right.
But it was about something more. It was about peace of mind, freedom, and making sure his choices matched his values.
I think that's really important. True wealth isn't just about having the most money. It's about aligning your choices with what's important to you.
Yeah, and he really emphasizes that finding contentment being happy with what you have, defining that enough is crucial for long-term happiness.
Yeah, otherwise you're just going to be chasing more and more, never satisfied.
It's like that feeling of, never having enough, and that can lead to anxiety.
Totally. Totally. Even people who have a lot of money, they can still feel that way.
Yeah. So we need to figure out what truly matters to us, define our own version of enough, and then design our financial lives around those values.
Yeah,
Don't let those external measures of success tell you what to do.
exactly. Exactly. And that ties into this idea of controlling your time, which Housel says is one of the most valuable things money can buy.
Right. It's not just about financial freedom. It's about having the freedom to spend your time how you want.
Right. And he even says the return on cash in the bank that lets you change careers or retire early is incalculable, right?
Right.
Because it buys you something more valuable than money.
Time.
Exactly.
Yeah. It's a really powerful way to reframe our relationship with money. It's not just about accumulating it. It's about using it to create a life that feels meaningful. A
Totally.
life where you can pursue your passions, connect with people, and experience the world on your own terms.
Yeah. And it all starts with recognizing that time is precious. And financial security, that feeling of enough, can give you the freedom to use that time in ways that truly matter. Welcome back to our deep dive into the psychology of money.
Yeah, in the last part, we really dug into those personal narratives, the impact of like luck and risk, and of course, the magic of compounding.
Right, right.
Now, I'm curious to explore how all these often hidden forces actually shape how we see the world, especially when it comes to money.
Absolutely.
One of the things that really stuck with me from the book was that story about the alien visiting Earth after the 2008 financial crisis.
Yeah, yeah.
And it's like completely confused because to the alien, humans are suddenly like way poorer and much more pessimistic.
Right.
But the physical world hasn't really changed all that much, just the perception.
Exactly. And I think it's a really clever way to illustrate the power of narratives, especially when it comes to economics. Housel says that, the 2008 crisis, it wasn't really triggered by some fundamental change in the economy. It was triggered by this shift in the narrative around housing prices.
So people just believed that housing prices would keep going up forever.
Yeah, and when that story fell apart, it created this ripple effect of fear. And that fear then actually caused the decline. It became a self-fulfilling prophecy.
It's like this collective loss of confidence.
Right, the shared story that takes on a life of its own, even if it's not entirely based in reality.
Okay, so that makes sense. But then he talks about this allure of pessimism, right? Like,
Right.
why are we so drawn to these negative predictions?
Well, I think it's because bad news feels more urgent. It gets our attention.
Yeah.
It taps into our fear of loss and uncertainty. So even if it's statistically less likely to happen, it feels more persuasive.
It's like that saying, if it bleeds, it leads.
Exactly.
Like, I might be skeptical if someone tells me I'm about to make a ton of money,
Right?
but if they tell me about some impending disaster, I'm all ears.
Right. And the media knows this, right?
Yeah.
So they focus on those dramatic, scary stories, even if they're not representative of the bigger picture. Think about it. You rarely see headlines celebrating the decline of heart disease.
Right.
But one plane crash can dominate the news for weeks.
That's a good point.
Aye.
And I guess evolutionarily it makes sense. Like, our brains are wired to pay attention to threats.
Right.
But when it comes to our financial decisions, that negativity can lead to missed opportunities.
Totally, totally. And Housel gives this example of Professor Igor Panarin, who predicted the collapse of the U.S. in 2009.
Yeah.
It was completely wrong, of course, but it got so much attention because it was scary. It confirmed people's fears.
Right. And it makes us think that bad things are more likely to happen than they actually are.
Exactly. We project those worst-case scenarios onto the future.
Right.
And we forget how adaptable humans are. Like, think about the oil crisis in the 2000s.
Yeah.
Everyone's saying we're running out of oil. It's only a matter of time before we have this global energy crisis.
Yeah.
But then what happened? Innovation happened. Fracking and other technologies actually increased production.
Right. It's like constraints actually drive progress.
Exactly, exactly. So it's not about ignoring risks. It's about putting them into perspective and recognizing that we're really good at solving problems.
Okay. So how do we actually combat that negativity bias? How do
Yeah.
we develop a more, a more balanced outlook?
I think one way is to focus on those long-term trends.
Okay.
Instead of getting caught up in the day-to-day news, step back and look at the bigger picture. Progress happens, maybe slowly, but it happens. And those setbacks, yeah, they're going to happen, but they don't negate the progress.
Right. So step back from those headlines and those anxieties that are constantly bombarding us.
Yeah, yeah. Become a serious possibilist, as Housel puts it.
Okay, I like that.
Acknowledge the challenges, yeah, but recognize that we have this amazing potential for innovation and positive change.
So balance prudence with a little bit of optimism.
Exactly, exactly.
All right, that makes sense. Now let's talk about those specific biases that kind of trip us up, especially when it comes to money. Housel talks about our tendency to gravitate towards stories that just confirm what we already believe.
Right.
He uses this example from the documentary, How to Live Forever, about this guy who lived to be over 100 years old. He lived through both world wars,
Wow.
and he firmly believed that World War I was the war to end all wars. It's like even after experiencing all that, he still clung to that belief.
It's a powerful reminder that our desires and hopes, they can cloud our judgment, right?
Yeah.
We want to believe the stories that make us feel good, even if they're not true.
And we see this all the time in investing. People are drawn to those gurus who promise easy riches, those get-rich-quick schemes.
Yeah, totally. We want to believe there's a shortcut to wealth, that we can skip the hard work and the patience.
Right. And this connects to Housel's point about everyone having an incomplete view of the world.
Yeah, yeah. We all have these blind spots. We fill in those gaps with stories that make sense to us, even if they're not entirely accurate.
He compares it to his one-year-old daughter. She's curious about everything, trying to understand the world, but she doesn't get things like jobs or bills.
Right.
So just like her, we all have those gaps in our knowledge.
Exactly. We create stories to bridge those gaps. And those stories become really powerful.
Yeah, they shape our decisions.
Yeah, our behaviors, even our perception of reality. And this is especially true when it comes to finance, which is so complex and uncertain.
Right, so we latch on to those explanations that fit our existing worldview, even if they're wrong.
Yeah, and that can lead to overconfidence, that feeling that we know more than we actually do.
Right, like we mistake that limited view for the whole picture.
Exactly.
So I guess the key takeaway here is we need to develop some healthy skepticism.
Absolutely. Be skeptical of your own beliefs and of the stories you hear out there.
Yeah.
Recognize that we all have biases. And be open to new information, even if it challenges what you think you know.
So question those stories, challenge those assumptions, and be open to seeing things in a new way.
Yeah, that's how we grow, right?
Exactly. Okay, so speaking of challenging assumptions, Housel tells this fascinating story about Julius Wagner-Jauregg, a doctor who won a Nobel Prize for treating syphilis with induced fevers. It sounds crazy, but it
Right.
worked.
It did work, and it's a great example of how sometimes those unconventional solutions can lead to breakthroughs.
Yeah, and it reminds us that sometimes those solutions are counterintuitive. They go against what I think is normal or rational.
Right.
And this connects to Housel's concept of reasonable rationality. It's about balancing logic with human nature.
Yeah, it's not about being a robot.
Right.
It's about making decisions that feel right, that consider your emotions.
Right.
He gives the example of Harry Markowitz, who won a Nobel Prize for developing this really complex, mathematically optimal investment portfolio.
Yeah.
But guess what? For his own money, he used a much simpler approach.
Really? So it's not about following some perfect formula.
No, not at all. It's about making choices that work for you,
Right.
that take into account your own risk tolerance and your own well-being.
Okay, so it's like personal finance is personal.
Exactly.
What works for one person might not work for another. And sometimes those irrational seeming decisions actually make sense for that individual.
Totally. Totally. And it's like that saying, don't let perfect be the enemy of good.
Yeah.
Sometimes those good enough decisions, those decisions that feel right, are better than trying to achieve some impossible ideal.
Right. And it's about, this idea he talks about loving your investments.
Yes, I love that concept.
It's about aligning your choices with your passions.
Mm.
If you're genuinely excited about the companies you invest in,
Right.
you're more likely to stick with them through good times and bad times.
If you believe in the company, you understand its mission, you're less likely to panic and sell when things get rough.
Okay, so invest with your head and your heart. Make choices that make sense financially and feel right emotionally.
Exactly. Exactly.
All right, now let's talk about fees, something we often try to avoid.
Yeah.
Housel says that we tend to view volatility as this penalty, like it's a sign that something's wrong.
Right.
But he suggests we think of it more like a fee.
Yeah, like the cost of admission. He compares it to buying a ticket to Disneyland.
Okay.
You pay the price for the experience. You know there's a chance it might rain or be crowded, but you still go because you value the experience.
So volatility is like the price we pay for the potential of those higher returns.
Exactly. Exactly. It's not always fun, just like those rainy days at Disneyland, but it's part of the experience.
And it just comes back to that long-term perspective, right? If you view volatility as like this short-term annoyance, it's easier to stomach.
Totally. Ups and downs are normal. They're part of the cycle. Over time, they tend to even out. If you're constantly reacting to those short-term movements, you're going to miss out on the long-term gains.
Right, so focus on the long game, not the day-to-day noise.
Exactly. Exactly. Have the discipline to stay the course. Now, he also talks about this thing he calls the different game problem,
Okay,
where investors make mistakes because they're taking cues from people who are playing a totally different game.
right. Like someone with a 30-year time horizon investing for retirement
Right.
versus someone who's day trading, trying to make a quick buck.
Totally different
Yeah,
games.
their goals are different, their risk tolerance is different. What works for one is going to be a disaster for the other.
Exactly. And it's so easy to compare ourselves to others, right?
Oh, yeah,
But you have to remember that there's no one-size-fits-all approach.
right.
What matters is finding the strategy that aligns with your own goals and your own situation.
Right. And it makes me think about the dot-com bubble. Those valuations were insane.
Right. But they made sense to the people who were playing that short-term game. They were riding the wave, hoping to cash out before it crashed.
So it's about like not getting caught up in the herd mentality.
Yeah. Right. Don't follow trends blindly.
Yeah.
Understand the fundamentals and know what game you're playing.
Okay, so define your own game. Stick to it even when everyone else is doing something different.
Exactly. Have the conviction to trust your own analysis.
Okay, that makes sense. Now, Housel also throws out this really interesting question. What if we're just bad at predicting the future?
Yeah, it's a humbling thought, right?
Yeah.
He points out that, unlike something like geology, investing is heavily influenced by human behavior, which is, well, unpredictable.
So we can analyze all the data we want, study the trends, but we can't know for sure how people are going to react.
And that's what drives the market.
Yeah. So embrace the uncertainty,
Hmm.
except that we don't have a crystal ball.
Right. It's not about finding the perfect prediction. It's about having strategies that can adapt to the surprises.
So have a plan, but be flexible.
Exactly. Exactly. And that brings us back to that margin of safety.
Right. Have that cushion, that buffer for when things inevitably go wrong.
Right, because they will go wrong. We're going to make mistakes. And that buffer can be the difference between a minor setback and a complete disaster.
It's about acknowledging that we're not perfect.
Totally.
Mm.
And that we need systems to protect us from ourselves sometimes. Now, let's shift gears a bit and talk about our personal narratives around money, those stories we tell ourselves. Because sometimes those stories can actually lead us astray.
Okay. Yeah.
Hazel talks about a friend who made this big financial decision based on something that happened to him as a kid.
Yeah.
But that experience, it might not have been relevant to his current situation at all.
So it's like those past experiences can shape our views on money, even if they're no longer applicable.
Exactly. It's like using a map that's for a completely different place.
So we carry these stories, these narratives that influence our choices without us even realizing it.
Yeah, and it's important to question those assumptions, right? Be willing to let go of those beliefs, especially if they're not serving you anymore.
Right. So ask yourself, is this belief based on solid evidence, or is it just a story I've been telling myself?
Exactly. Be open to new information. Be willing to update your beliefs as you learn and grow.
So be flexible, be adaptable, and don't be afraid to admit when you're wrong.
Yeah, that's how we learn and make better decisions. Now, Housel also dives into this interesting idea of sunk costs. You know, those investments or efforts that you can't get back.
Right.
He says we often make irrational decisions by clinging to those sunk costs, trying to justify those past choices even when it's clear we should move on.
Okay. Yeah, like staying in a job you hate just because you've been there for so long.
Exactly. We get emotionally attached to those past investments, the time and money we've already put in. It's hard to let go.
Right? So you're trying to prove you weren't wrong, even if it makes you unhappy now.
Yeah, and it ties back to that end of history illusion, that idea that our past selves are fixed. We cling to those old decisions and beliefs.
So we need to give ourselves permission to let go of those past decisions.
Yes. Recognize that we've grown, we've learned. Make choices that reflect who you are now.
Right. So embrace change, be flexible, and acknowledge that you're not defined by your past choices.
Exactly. Exactly. And you know, this idea also applies to how we judge others, especially those in positions of power.
Okay.
He uses the example of Jeff Immelt, the former CEO of General Electric. He was heavily criticized for the company's struggles, but a lot of those were due to things he couldn't control.
Right, so even the best leaders can't always overcome those unpredictable market forces.
Exactly. It's easy to judge from the outside to think we would have done better,
Right.
but it's a lot harder when you're in the thick of it, dealing with all that complexity.
So have some empathy for those leaders.
Right.
Recognize that they're making tough decisions with the information they have at the time.
Totally. And this ties into that concept of room for error again, not just for individuals, but for organizations too.
Okay.
Companies need that cushion, that margin of safety for those unexpected events. They need to be able to withstand those shocks.
So build those systems, those financial buffers.
Right. Recognize that you can't control everything.
Yeah. Okay, now let's talk about this idea of paying the price. Recognizing that we rarely get something for nothing.
Yeah, that's a big one.
We often try to find those shortcuts, those hacks, those loopholes. We want to beat the market without putting in the work.
He compares it to stealing a car.
Okay.
Like, most of us know we can't just take what we want. There are consequences. But in investing, we often try to find those easy paths to wealth.
We try to game the system, but the system usually wins in the end.
Exactly. And that leads to things like market timing,
Yeah.
trying to predict the ups and downs and get those gains without taking the risk.
But it's so hard to get that timing right.
It is. Most of us are just not good at predicting the future.
So accept that volatility is the price you pay. There's no free lunch.
Right. Focus on the long term. Find a strategy you can stick with.
Okay. Now let's talk about luck. We often underestimate its impact, right?
Absolutely. Housel uses Bill Gates again as an example. Going to that school with early access to computers, that was pure luck.
Right. Being in the right place at the right time can make all the difference.
Yeah, and it's a good reminder that we don't always control our own destiny.
So be grateful for those lucky breaks.
Yeah, and have some compassion for those who haven't been as fortunate.
Right. It's not always about how hard you work. Sometimes it's about being in the right place at the right time.
Totally. And this can help us have a more balanced view of risk and reward. If we acknowledge that luck plays a role, we're less likely to take unnecessary risks.
Right. We can be more responsible and more forgiving of ourselves.
Yeah. Now, let's circle back to compounding for a minute.
Right.
Because it's so important. Housel describes it as this magical force that can turn small, consistent efforts into big wealth.
Right. But it takes time.
It does.
Yeah.
He compares it to how glaciers are formed. Those tiny snowflakes, over centuries, they build up into these massive structures.
Yeah.
It's the same with investing. Those small contributions, over time, they can become something huge.
So patience and discipline are key here.
They are. Compounding takes time. It's easy to get discouraged when those gains seem small at first.
Right. But you got to trust the process.
You do. Find a good strategy and stick with it.
Like Warren Buffett. He didn't get rich quick. He just kept investing consistently for decades.
Exactly. Slow and steady wins the race when it comes to building wealth.
Right. Resist those temptations to chase those quick wins.
Absolutely. And this ties back to that end of history illusion. If we think our current situation is permanent, we're less likely to make those long-term commitments.
Right. So recognize that you're constantly evolving. Your goals will change, your needs will change, and your investments should change too.
Totally. It's about finding that balance between sticking to your plan and adapting to new circumstances.
Right. So have a plan, but be willing to revise it.
Exactly. Now, let's talk about something that can be really hard in today's world, defining what enough means to you.
Yeah, especially with social media and all these messages telling us we need more.
It's easy to get caught up in that comparison game, to always feel like you're behind.
Right. You're never satisfied.
And Housel reminds us that happiness isn't about constantly getting more. It's about finding contentment with what you have.
And he uses his own example of paying off his mortgage.
Right, even though it might not have been the most financially optimal move.
Yeah, but it gave him peace of mind.
It did, and a sense of freedom.
So it's not always about maximizing those returns. Sometimes it's about making choices that align with your values.
Absolutely. Financial decisions should be guided by what's important to you, not just by some spreadsheet.
Right. So create a financial life that feels authentic, that reflects your priorities.
Exactly. And that brings us back to this idea of time, right?
Yeah.
Money can buy you time. Time to do the things you love, to spend with the people you care about, to pursue your passions.
So it's not just about financial freedom. It's about having control over your time.
Exactly. And that's a kind of freedom that's priceless.
All right. Welcome back to our deep dive into the psychology of money.
Yeah, we've covered a lot of ground so far.
Yeah, we've talked about the power of stories, those dangerous biases. We even explored the importance of figuring out what enough really means for you.
Right, right. But now it's time to get practical.
Yeah, let's actually talk about what can we do with all of these insights? How can we improve our own financial lives?
Yeah, it's the million-dollar question, isn't it? And, I appreciate that Housel doesn't give us some rigid step-by-step plan. Instead, he gives us these principles, these ways of thinking about money.
Right. It's about developing those good habits, those mindsets that help us, not just with our money, but with our overall well-being.
Exactly, exactly. And I think one of the most powerful takeaways, even if it seems obvious, is the importance of saving.
Yeah, it's so easy to overlook that, especially when you're caught up in, trying to earn more.
Right. But building wealth, it's not just about how much you earn, it's about how much you keep.
Right.
It's about being consistent, putting money aside, even if it's a small amount. Pay yourself first.
Make it a habit.
Exactly. And he really gets into the psychology of saving, which is often the hardest part.
Yeah, it's not just about, logistics, right? It's about those mental hurdles.
Totally. He talks about creating a gap between your ego and your income.
Okay, that's
It's
interesting.
not about deprivation, it's about recognizing that you don't need to spend every dollar you make.
Right, so many people with good incomes save very little. And it's not because they can't afford to save, it's because they're trying to keep up with the Joneses.
Yeah, exactly. They buy things they don't need to impress people they don't even like.
It's like that saying, we buy things we don't need with money we don't have to impress people we don't like.
Right. And all of that is at the expense of our future selves.
Yeah. So be honest with yourself about why you're spending. Recognize that true wealth is often about what you don't buy.
Yeah, it's about aligning your spending with your values, not with those external pressures.
Right. And this brings us back to that idea of enough. Right.
Exactly.
Housel reminds us that happiness isn't about constantly getting more. It's about finding contentment with what you have.
And he talks about his own decision to pay off his mortgage.
Yeah.
It wasn't the most financially optimal move on paper.
Right. But it gave him peace of mind.
It did. It aligned with his values.
So our financial decisions, they should be guided by those things, by our values, not just by the numbers.
Totally. Ask yourself, what truly matters to me? And then build your financial life around that.
Okay, that makes a lot of sense. Now, let's talk about investing, which can be kind of intimidating for a lot of people.
Yeah, it can feel really complex, especially if you're just starting out.
Yeah. But Housel really emphasizes the importance of that long-term view, right?
Absolutely. Don't try to time the market.
Right. Or chase those quick wins.
Yeah. Most of us are just not good at predicting the future.
No matter how much we analyze things, we can't know for sure what's going to happen.
Right. Embrace that uncertainty. Find a simple strategy and stick with it.
Okay, so what does that look like in practice?
He's a big proponent of index funds.
Okay.
They give
Cool.
you that broad market exposure, they're low cost, and you don't need to be an expert to invest in them.
Right, so diversify, keep those fees low, and let time work its magic.
Exactly. You don't need to hit a home run every time. Just keep getting on base and you'll be successful in the long run.
Okay, now let's talk about something that trips a lot of people up, dealing with those emotions.
Yeah, emotions can make or break you when it comes to money.
And Housel really highlights the importance of having a plan in place, especially during those times when the market's volatile or you're stressed out.
Yeah, it's like a prenup for your finances.
Okay.
You decide in advance, when you're calm and rational, how you're going to handle those tough situations.
Right, because when emotions are running high, we don't always make the best choices.
Right. So having that plan, that strategy you've already committed to, it can help you stay grounded.
Yeah, you're less likely to make those impulsive decisions.
Exactly. And he also talks about the importance of having a support system,
Hmm.
people you trust to talk to about your finances.
Right, you don't have to figure it all out on your own.
Totally. A good financial advisor, a trusted friend, even a family member, having those people in your corner can make a big difference.
It's about building those relationships, those connections that support you on your financial journey.
Okay, so we've got saving, investing, managing those emotions, having a plan. What else is there?
Well, something that really resonated with me is the importance of building a margin of safety.
Yeah, creating that cushion for when things go wrong.
Right, because they inevitably will, right? Job loss, medical emergency, even just a market downturn. Having those reserves, that financial flexibility, it can make all the difference.
Absolutely. It's like an emergency fund, but it's also about being conservative in your planning, not stretching yourself too thin.
Right. Create that space for error.
Exactly. And this also connects to his point about avoiding leverage, using debt to try to boost your returns.
Yeah, leverage can be really tempting, but it can also be really dangerous.
It can wipe you out if you're not careful.
So play it safe, avoid those excessive debts.
And Housel also encourages us to think about volatility differently.
Okay, how so?
He says instead of seeing it as a penalty, see it as a fee, the cost of admission to participate in the market.
It's a different way of looking at it.
It is. It takes some of the emotion out of those market swings. It's just part of the game.
Right, so accept it, don't react to it.
Exactly. Focus on the long term. And remember, time is on your side. And finally, I think it's important to remember that personal finance is about more than just money. It's about building a life you love.
Right, it's about using money as a tool to create that life.
Don't chase the numbers for their own sake.
It's about experiences, relationships, fulfillment.
Exactly. True wealth is about more than just your net worth.
This has been a fantastic deep dive into the psychology of money.
It has. We've covered so much ground.
Yeah, from the power of those narratives to the magic of compounding.
The importance of understanding our own biases and, of course, defining what enough means to each of us.
Yeah. But it all comes back to this, understanding those psychological forces that drive our decisions about money and using that knowledge to make better choices.
To create a more secure and fulfilling future.
So as you go on your own financial journey, remember to be mindful of your own psychology. Challenge those assumptions, embrace those long-term views, and focus on building a life that's rich in both financial and personal wealth. It's a journey, not a destination. There will be ups and downs, but by understanding the psychology of money, you'll be much better equipped to navigate those challenges and create a life that feels both prosperous and truly fulfilling.